Hello everyone, my name is Laura Mattern and I'm a Portfolio Manager Assistant here at Johnson Investment Counsel, and this is JIC Research Edge. I'm joined today by Dale Coates, who's a Vice President and Portfolio Manager within Johnson Asset Management. Dale's here to provide a brief overview of what happened in the market in 2018 and what we may expect going forward. Dale, the market last year was a lot different than 2017. What happened in the market in 2018?
Well, first of all, volatility was clearly higher in 2018. After a very stable year, volatility simply returned to more normal levels. For example, last year there were 64 days with at least a 1% price swing in the market, compared to only 8 days the previous year, so a significant pickup. But the historical average is exactly 64, so it was really pretty normal. The other thing was that we went from a very strong year in market returns in 2017 to an actual decline last year. There have been 25 years historically when stocks declined, or roughly once every 3 or 4 years. And when the market declines, on average, it's a drop of about 14%. So last year's 4% decline was relatively modest. But I think the most noteworthy thing about 2018 was the fact that 90% of all asset categories declined in value, by far an historical record. Virtually nothing moved higher. And as a result, diversification was much less helpful than it normally is.
Tell me about your outlook for 2019.
Well, the good news is, after a very strong year of earnings gains, combined with the lower returns we experienced last year, has set the market up for much better valuation. And historically, better valuations ultimately lead to potential better returns. So that's a positive. The other is that after big market declines like we experienced in the fourth quarter, stocks have often recovered in the next 6 to 12 months. That's assuming there's not a recessionary environment. And finally, we think bond returns could be much better in 2018. And that's because bond yields are much higher than they've been at any point in the last decade. And as the Federal Reserve gets to the end of their interest rate cycle, we would expect bond returns to improve. And it's for that reason that we actually added to allocations in bonds last year.
What are some risks to watch for in the year ahead?
Well, there's always lots of risks to prepare for, but I think two stand out. The first is the Federal Reserve. So the Federal Reserve has been increasing interest rates for several years, and today their rate is very close to their target for short-term interest rates. And as a result, they may be near the end of their cycle. And if they are, that would be a positive. On the other hand, if they continue to raise rates next year, we would expect that to be negative for investment results. The other thing that we're keeping our eye on, of course, is the health of the global economy. It's our view that the economy is slowing but still growing, and the many economic indicators we monitor validate this outlook. The Conference Board's leading economic indicator might be a good single measure to keep your eye on to monitor this risk. Today, it's well above recessionary worry levels.
That's very helpful. Thanks for your commentary, Dale. And thanks to all of you at home for watching. If you're looking for our more detailed views on the market, keep an eye on our website at www.johnsoninv.com, where an in-depth outlook video will be posted in a couple of weeks. As always, if you have any questions, reach out to your team here at Johnson. We're more than happy to help.